All right, welcome everyone, and Happy New Year. I cannot believe it's 2019. It just feels so crazy for me, but I am excited to be able to share this webinar with you. Chair Bekaert does this on an annual basis, just a review of what happened last year, sort of like, when you step back and the whole year goes by and you say, what happened? Well, a lot happened. 20 ASUs actually happened, believe it or not. So no shortage there of things to talk about. We are going to walk through all 20 ASUs. Now, this is not meant to replace an in-depth review of these ASUs. They're meant to be an executive overview. I'm going to introduce them, and then you're going to say, nah, that doesn't apply to me. I don't need that. Or, ooh, that applies to me. I need to learn more. All right, so they're not meant to be all-encompassing. They're there to be an executive overview to give you that opportunity to think about how you could apply it. So super duper excited to be able to introduce this. So let's again, dive on in as we go through this. And so my name is Melissa Galasso. I'm a director in the Charlotte office for Chair Bekaert, and I am excited to have the opportunity to work in professional practices, primarily doing training for our internal and external users. So let's start off with a quick polling question about you. Tell me a little bit about who you are. Now, remember, you must go in and click on that poll in order to get continuing education credit. So we do want to make sure that you are filling this out. And so we have choices of nonprofit education, industrial manufacturing distribution, real estate construction, tech life science, and then the ever exciting other. No surprise there, as there are so many different ones I'd love to be able to include, but there's a maximum number of options to be selected in GoToWebinar. They don't let us have an unlimited number of selection options for you, so I feel bad for you if you're selecting other, but know that your industry is important to us. All right, give you a couple more seconds to complete that. Looks like most of you have voted. In a not surprising fashion here, all right, let's close that out. 44% of you are coming from nonprofit and education, which is pretty consistent. And then the next largest is 37% with other, so no shocking information there. So thank you guys so much for that. All right, so let's walk through our ASUs. So the first one that came out, ASU 2018-01, is related to land easement, and in particular, topic 842. What you will notice about the ASUs issued in 2018, they really came in four flavors. The first one are amendments to the lease standard. Then there was amendments to the financial instruments suite. Then there were industry changes, and then those that were what I would call general. So those are the four types of ASUs that were issued. Not surprising, as the topic 842 for leases is effective in 2019 for public entities, and it's going to be effective in 2020 for private entities. And so public companies, because they have to report their information on a quarterly basis, basically had to get their adoption ready in 18 to be able to have it to go on January 1 of 19. And so as a result, lots of questions came in, and we saw a lot of implementation questions and some confusion that the FASB took the time to address in the year prior. We saw that very similarly with revenue recognition. So as public companies were going through that, we saw a flurry of revenue recognition amendments because people were asking questions as they were trying to implement. So this is a very common process, and we expect to see more financial instruments amendments simply because that's the next one that has the really big impact. So we're going to keep going through these. And then obviously the FASB has a very full agenda that gets attention as well. So again, we want to make sure that we are pulling all of this through. So the question that came up here is related to land easements and its relationship with topic 842. Now, remember, the whole big thing with 842 was that all assets, all leases were going to go on the books as assets and liabilities, where we're not going to have a difference between operating leases and what we call today capital leases, going forward finance leases, on the balance sheet. So they were going to be the same on the balance sheet, different on the income statement and cash flow statement. And so because we were putting them all on the balance sheet, some questions came up. And that's because there's actually diversity in practice today in accounting for land easements. Some entities do follow Topic 840 for leases for those land easements. Remember, an easement gives someone the right to use your property. So, utility companies, for example, will have to put up a tower, for example, on someone else's land, and that's typically done through an easement. Governmental entities have lots of easements. And so when you are doing these easements, some entities already use the Topic 840 for leases. However, not everyone does. Some people actually use Topic 350, which is intangibles, and they recognize the right to use someone's property, kind of almost in advance of what the FASB comes to for leases, right? So today we recognize a lease asset on our books, and it's the asset itself. Under Topic 842, we recognize the right to use that lease. And so I think that's really important that some people actually sort of beat the FASB to that conclusion, and we're treating these land easements as intangibles under Topic 350, and then others were actually treating it as PP&E under Topic 360. And so there is already diversity in practice in this area, and what people were giving feedback was, well, if I already have the asset on my books, what benefit is there from going through and trying to determine whether the agreement meets the definition of a lease under Topic 842? And so I already have the asset on my books. I'm already using Topic 360 or I'm using 350 or 360. What benefit do I have from going through and trying to make this analysis? And so ultimately, they fell on ears of FASB that said, you know what, it kind of makes sense. If I already have the asset on the books, that was really the big change. We didn't really change the income statement. We didn't really change the cash flow statement. So perhaps this is something that's not necessary. And so basically what happens here is there's a practical expedient. And so if you are not treating it as a lease today, if you're treating it as a lease today, then you're going to follow Topic 842, right? So you're going to follow lease accounting because you have it as a lease today, you're going to have it as a lease tomorrow. Well, you might have it as a lease tomorrow. You have to make an evaluation of whether you're still within the scope of the lease standard, but you're going to have to adopt Topic 842. On the other hand, if you don't currently apply lease accounting today, then they're going to give you a practical expedient. And basically, that practical expedient says that you don't have to adopt Topic 842 retrospectively. Instead, you would apply it prospectively to any new or modified land easements, and then have to determine whether it meets whether the contract should be accounted for as a lease under Topic 842. But if you have an existing lease or an existing land easement or a expired land easement, you do not have to go back and try to determine if it would have met the definition under 842. You would just apply 842 prospectively to new ones or ones that are modified. So it's a nice practical expedient there for certain industries. Now, again, they were more prevalent in certain areas. So, telecom, utilities, tend to have a lot of these. Other entities are like, I don't have any land easements, and you then don't have to worry about this standard. So the effective date would obviously follow along with ASU 2016-02, which creates Topic 842. However, if you did early adopt, you would just adopt this standard upon issuance. The next standard has to do with taxes. That was another one that we saw. We saw two ASUs that came out of the tax world, and that is because of the Tax Cuts and Jobs Act. Now, I teach a lot of CPE. That's what I do for a living, and I teach a lot of accounting and auditing classes. That's my area of expertise. However, this year, I actually had to, or I guess last year in 2018, start really doing some research on taxes, and that was because of the big changes in the Tax Cuts and Jobs Act had an impact on how financial reporting would actually work. And so as a result, I needed to understand the changes in the tax law to understand the changes in the reporting of those taxes for financial reporting purposes. And so I ended up having spent quite a bit of time looking at taxes, which is really unusual for me. And so the ASU here, 2018-02, has to do with the Tax Cuts and Jobs Act. Now, that was issued back on December 22nd of 2017. Now, why is that date important? Well, the date of enactment is what drives accounting, not the effective date. So many people didn't understand that. It's the enactment date that updates the deferred taxes, not the date that it becomes effective. So once the tax bill was enacted, we had a couple of questions that popped up. And the first set of people was actually an unsolicited comment letter. So FASB originally had no intention of issuing this ASU. They didn't have it as a project. It wasn't on their agenda. And then all of a sudden, FASB started getting letters that said, hey, we have a big issue. Have you guys noticed that? And this is like the fastest turnaround in the history of FASB statements. Like it was a 2-week comment period, and then within 2 weeks, we had a final standard. Like it was the quickest thing I've ever seen come out of FASB. Remember, it took 10 years to write leases and 10 years to write RevRec, and this thing was issued in under 45 days. So really impressive, in my opinion, on how this one went down. But basically, some stakeholders realized that the way it works for financial reporting purposes is that if you have a change in your corporate income tax rate, on the date of enactment, you have to go through and calculate any deferred taxes to reflect the new income tax rate. However, this is the problem. When you do that change in the income tax rate, it is going to go through net income. The problem being that some of those deferred taxes are not related to retained earnings. They're actually related to AOCI. So a great example would be if you have an available for sale debt security and you're recognizing unrealized gains and losses. Well, for tax purposes, you don't get to recognize them. You have to wait until you have a realized gain or loss. And so that gives us a temporary difference, which leads to having deferred taxes. Well, these deferred taxes are going to go on at the date when we put them on at the historical corporate income tax rate. Well, when we go to update it, we're going to take the change from, say, 35 to 21. We're going to take that 14% change, and we're going to flow it through net income. The problem being that the tax effect is really sitting in OCI, right? And so it sits on the balance sheet in AOCI. So you're cleaning up the retained earnings when you really should be cleaning up the AOCI. Now, this has always been the case. That's how we do accounting. But in the past, we've changed our income tax rate 1%, 2%, and it really wasn't material. What we found out in 2018-02 is because it was such a large change, some companies were like, this is materially impacting us. And so as a result, ASU 2018-02 allows entities to reclassify out of AOCI and into retained earnings those stranded tax effects. Now, they have to be explicitly for the Tax Cuts and Jobs Act. Meaning you can't have, if you have prior changes in tax code that is sitting in AOCI, it does have to stay there. They're only allowing the reclassification for the impact of TCJA. And so basically you're going to have to, you would just move it out. Now it is an option, they're not requiring it. However, everyone has to adopt the standard because of the disclosure requirement. There is a disclosure requirement regarding your policy for whether you are releasing the income tax impact. So if you choose to elect the policy, you would have a statement that you did reclassify the income tax effects, and then you would give a description of the impact. However, if you do not make the election, you still have a disclosure. You would actually have to disclose that you did not reclassify the income tax effects. So while ASU 2018-02 provides us an alternative, everyone has to elect it for disclosure purposes. And so the important thing here is it's for fiscal years beginning after December 15 of 18, which would be calendar 19. However, most people are early adopting this because obviously the impact is in prior years. So you have choice in terms of the adoption. You could either do it retrospectively to all the periods that were impacted, or you can just apply it in the period of adoption. So you do have a couple of options here in terms of the transition. ASU 2018-03 is a technical correction. So typically, FASB always has on its calendar a list of things that people identify as being problematic. So these are what we call technical corrections. And when they are looking at them, what they're trying to do is just make the codification better. Sometimes they are just little targeted improvements. Sometimes they are literally fixing typos, bad links, etc. And so FASB has an ongoing project, and its project is basically to keep up and make sure that the codification is always accurate. So they're usually unintended application issues or little improvements to clarify the codification. They typically are not expected to have a significant impact on accounting because a lot of times it's really just these minor edits. However, And what they do typically is once a year, they put out a technical corrections, and we will see an ASU in a few slides that is on those technical corrections. However, when it's related to a massive project, what FASB has been choosing to do is issue those technical corrections separately. So today, we're going to talk about a technical corrections related to financial instruments. We'll also have a technical correction specifically related to leases, and then we'll have the generic technical corrections. And so instead of lumping all of these into the generic technical correction, they decided instead to pull and and bring attention to it separately. And so that's why we have ASU 2018-03, and it has a bunch of different areas. So looking at 2016-01, one of the big differences is that there is no cost method. Under the 2016-01, they eliminate the cost method, but they do have specialized guidance related to equity securities that don't have a readily determinable fair value and don't qualify for NAV. They provide an alternative measurement method for them. Well, there were questions about when do you discontinue that alternative measurement method? How do you make adjustments to that alternative measurement method? And so, and then transition guidance related to that measurement method. So that was a really popular one. In addition, there were some questions regarding forward contracts and purchase agreements, and specifically, there was a question about whether the change in observable price or impairment would result in remeasuring the entire value of the forward contract or purchase option. So they wanted to clarify that one. And then there's two areas that are being adjusted by the fair value option. Typically, prior to ASU 2016-01, if you elected the fair value option, the entire amount of fair value adjustment would flow through net income. But under 2016-01, the instrument-specific credit risk actually flows through OCI. And so there were questions that came in about presentation and what happens if something was denominated in a foreign currency, how that would impact the split between net income and the OCI components. And so they did provide some updates here. So not surprising, this is effective with 2016-01. However, there's some issue with that because public companies have to file quarterly. And remember, when this came out, they were already in the middle of their first quarter of 2018. This came out in February. And so as a result, they didn't want to penalize companies. And so there is a little bit of a adjustment that if you're a public business entity and you had a fiscal year beginning between December 15, 17 and June 15 of 18, they said that you did not have to adopt those in the interim period until after the June 15 of 18. So basically your first two quarters, because now you have to go and look at the impact of this, they gave them a little bit more time. For everyone else, they basically adopted it along with ASU 2016-01. All right, so that brings us to our next polling question. So let's take a look here at our new poll. And this one is, if you have an accounting question, where do you go? So do you call up that FASB or GASB website? Do you call up your auditor? Do you Google it? Is it the internet? Do you call the AICPA's technical hotline or find an AICPA guide? That's probably one of my favorite ones to look at. Or is there some other way that you like to communicate, right? So is there a way that you like to go and get your questions answered? I'm not above actually calling FASB or GASB. I really like to talk to them. They're some of the nicest people out there. So I'd like to pick up the phone and ask them a question or shoot them an email. So they're some of my favorite people. I also have been known to Google it, but I typically don't Google the internet. I do go into the codification or into the actual technical guidance and search around within there. The internet is not always up to date, and so I like to stick to the codification to the extent possible. So that all kind of works in. Looks like most of you have answered here, and so thank you. So it looks like your auditor is number one, so I'm grateful to see that you think of your auditor as a valued resource, followed by the internet number two, and then the FASB-GASB website number three. All right, so let's close that poll. Excellent job. All right. So our next one here is an SEC-specific update. You'll see a few of these as well. This one is also related to ASU 2016-01. And basically, the theory here is that technically, according to the laws of the United States, the SEC is responsible for writing GAAP. However, what we know is that they have delegated that responsibility to FASB. However, if they ever want something above and beyond explicitly for public companies, they have the right, and they do, write specific GAAP. And so they will issue what they call staff accounting bulletins or staff releases. And so what they do is they say, hey, this is specific to SEC companies. We want this above and beyond what FASB says. Well, when ASU 2016-01, it made changes to recognition and measurement for financial instruments, and one of the things that it made changes to was related to the what we call other than temporary impairment. Only accountants would not call that permanent. We called it other than temporary. Well, there was a staff accountant bulletin in topic 5M on specifically other than temporary equity securities for SEC specific. Well, now that FASB has changed those rules in ASU 2016-01, all we're doing here is we're seeing FASB go through and bring SEC guidance in alignment with the new FASB guidance. So basically, the SEC issued two different releases, which basically said, we're not going to, so the Staff Accounting Bulletin 117 says, you know what, we're just going to follow FASB GAAP, and then the SEC release took outdated forms and amendments and basically brought that in line with current GAAP. And so all this standard is doing is bringing in the SEC guidance to conform with topic 321, which is the result of ASU 2016-01. So they're just basically saying no SEC specific guidance here, just follow what FASB has told us. As a result, it is effective upon issuance. You would just follow along with the FASB guidance. As promised, there is our second income tax topic, and this one is also an SEC topic. However, many of you on the line are not from SEC clients, and I want to tell you that that doesn't matter in this scenario. You can actually adopt the standard. So there's a staff Q&A that FASB put out that said, while this is SEC-specific guidance, if you want to follow it, we would be totally okay with that. And so some private companies have actually adopted 2018-05 because they like the alternative accounting under the income tax rules. So if you have an impact on TCJA to your company, this might be something that you would want to consider. Even though it says SEC, it still could be something that you would want to adopt. And basically, the issue here is that when they issued the Tax Cuts and Jobs Act, again, enacted on December 22nd, the very same day, the SEC put out Staff Accounting Bulletin 118. And basically, because the Tax Cuts and Jobs Act makes so many changes, right? We talk about the corporate tax rate, but it also changes business-related exclusions, deductions, credits. There's a lot of international consequences. And so as a result, people were like, well, I don't know what I'm going to be able to do here. There's so much happening. And so we don't know what the accounting should be, and we don't have a lot of time to make that determination because the enactment date falls at the end of the year, and literally 9 days later is my fiscal year end. So we're like really confused at how this is going to work. And then immediately after that, the actual effective date is January 1. And so people kind of were like, we don't know what we're going to do. And so basically, the SEC is giving people an option here. So they said to the extent that you have an estimate, that you're able to come up with a reasonable estimate, you've gone through and you're still trying to fine-tune your estimate, you're still doing some analysis, but you have a reasonable estimate, we want you to book it. However, we're going to let you book it as a provisional amount. And what's good about a provisional amount is that you can continue for up to a year, edit that amount, and it's not deemed to be a correction of an error. It's just an update to a provisional amount. We use the same concept of a provisional amount in our business combinations world. So as things are being updated and finished and finalized, we let people make adjustments without having to treat it as this big change in accounting principle or change in an estimate, et cetera. We're just going to allow people here to go through and make edits to that provisional amount. Now, if you're saying, look, I don't have the information I need to close my books, or I have it, but I haven't actually analyzed it, I haven't made a computation, I don't even have an estimate, the SEC actually said don't book an estimate. So to the extent that you have absolutely no idea what the impact of TCJA is and you have not gotten a number that you're comfortable with, you would just apply Topic 740 based on the laws that were in effect prior to TCJA being impacted, and you would not change your current or deferred taxes for TCJA until you could come up with a reasonable estimate. So they basically allowed an option to say, yeah, I know this number is not reflecting the new law, but that's because we just don't have time. And so what they're going to allow us to do then is take the time that we need to come up with the right estimate instead of just throwing a number out there that we know is wrong. Now, if you have a reasonable estimate, we're going to let you book it as a provisional amount. Now, remember, all of this only relates to TCJA. It has nothing to do with any other tax laws or any changes. It only is an impact of TCJA itself. Now, one of the things that comes with this, so people love this aspect, right? I don't have to book an entry if I don't know what it is, or if I do book an entry, it's a provisional amount. There is the catch that there are some different disclosures. So you would have to disclose, for example, the impact of what is incomplete, right? You would have to tell people what is a provisional amount. You'd have to disclose what current or deferred taxes have not been completed, so people know that, hey, by the way, I haven't updated this. They also make you tell them why the initial accounting is incomplete and what additional information you would need in order to complete the accounting. And then if you do have any measurement period adjustments, you would have to indicate the nature and amount of them and the impact of any measurement period adjustments on the effective tax rate. And then finally, once you have come up with everything and you're kind of finalized, you would indicate that the income tax impacts of TCJA has been completed. So this was effective upon issuance. Right after this came out, the FASB staff issued a Q&A saying, yes, if you're a private company, feel free to use this as well. All right, let's move on to another one. This is not going to have any impact, hopefully, on anyone, theoretically. This ASU is just cleaning up, again, the codification, and it is a codification improvement, except it's, again, for a particular industry, so they wanted to call attention to it. So basically, the comptroller of the currency had a Circular 202, which was accounting for net deferred charges. However, that has been superseded. Guidance was actually the Congress repealed the information, and so as a result, they became superseded. It's no longer relevant, so the guidance was rescinded by the Office of the Comptroller of the Currency, and it's no longer relevant. However, it's in the codification because it was there when it came out. So basically, all this does is supersede Topic 942-740 on Topic Circular 202. Because that was rescinded, it's no longer relevant. They're just pulling it out. So impact should be nothing because it's no longer relevant. So we're just cleaning up the codification. One of the ones that depends on your industry would be more or less relevant. When I teach courses in, say, like a Raleigh area, we see a lot of interest in this. We have a lot of startup companies who may be low on cash who have started to pay some of their non-employees with share-based payments. So, for example, they might pay a vendor with shares instead of cash because they don't have the cash on hand. In other areas, when I teach this, people have no interest because this is not something that all entities do. So non-employee share-based payment is very much based on your industry and the type of company that you're in. But basically, this was a goal to clean up and simplify to some extent the non-employee share-based payment. So prior to the standard, we actually had subtopic 505, and that subtopic would address the non-employee share-based payment. And then we had topic 718 that covered employee share-based payment. And what we found was that non-employee share-based payment hadn't gotten the same TLC that topic 718 did. And so 718 was far more complete. It really addressed a lot more topics, and topic 505 was not quite there. And so what happened was people started to look and say, hey, I'm trying to look at this, transaction, and there's no guidance in 505. The SEC actually said, well, then go to topic 718 and analogize that transaction there. And so FASB took on the project of trying to beef up topic 505. Well, fun fact, it's very hard to do so. And so instead of updating topic 505, they actually expanded the scope of topic 718 to include both employee and non-employee share-based payment. And so as a result of this, what we're going to find here is that the what you'll see is the topic 718 now has both in there, and they tried to streamline them to be more consistent. So when you're looking at the accounting, they'll be a little bit more streamlined than they are today. And so this will be a nice plus for those entities who are doing the accounting here. And this is effective for public business entities in 2019 calendar year ends, everyone else 2020. Early adoption, however, is permitted, but no earlier than your adoption of revenue recognition. All right, so Cherry Bekaert earlier this year did an entire 1-hour webinar just on this standard, and so clearly in a 1-hour webinar on 20 standards, it's not going to get the same TLC, but if you are a nonprofit and you did not watch the Clarifying the Scope and Accounting Guidance for Contributions, I highly recommend you go back to the CBH website and you click on webinars, and you can actually always view all of our past webinars anytime. You won't get CPE credit for it, but this is not about being compliant, it's about being knowledgeable. And so we want you to know what's going on in this area. So if you are in the nonprofit world, and I know almost half of you are, if you did not watch that webinar, I would encourage you to go back and take a look at it. It's one that I actually taught myself, and I would definitely recommend because we went over a lot of really interesting examples, and you might learn something from those examples. So in this scenario, they are making some pretty big changes in 2 different areas. They're making a change to what is a contribution versus an exchange transaction. This really came out because Topic 606 has all those new disclosure requirements, and as a result, if you say something is an exchange transaction, you have to file Topic 606. If you are a non-exchange transaction, you're a contribution, you don't follow 606, you follow the contribution accounting in Topic 958. And so they wanted to make sure things like grants got some attention. And so they actually changed the indicators, and a lot of things that are treated as an exchange transaction today will going forward be a contribution. In addition, because there's so many more things that will be contributions, they really took a look at conditional contributions, and they made some changes there. So they actually changed the definition of a condition. Today, a condition is a future uncertain event. Going forward, it is going to be an agreement that has a barrier and then a right of return or right of release. And so because the concept of a barrier is new, it introduces 3 indicators that would tell you have a barrier. So as a result, while more transactions are going to be contributions, many of those transactions are actually going to be conditional contributions, which impacts the recognition of those. So if this is something that interests you, again, we have that much fuller webinar out there for you. If you are the recipient of these grants, it is for June 15, 18, and beyond for public business entities. For private entities, it would be calendar 19, which will actually align with your adoption of revenue recognition. However, if you are a public company or any entity that actually provides these grants, the guidance was applicable for you for calendar 19 for public business entities, and then for everyone else, 2019. Those asterisks there do indicate that when we use the term public business entity, it also includes nonprofits that have issued or conduit bond obligors. So we do have that little kind of adjustment there. When we say public, we are talking about nonprofits that have conduit debt in that public as opposed to treating them as private. All right, so that brings us to our next polling question. And let's take a look at what that polling question is going to be. All right. Oh, I love this one. Did you make a New Year's resolution? And so this is a yes/no question. We are 10 days into January. So did you make a New Year's resolution for 2019? Many of you know that my birthday is December 31st. And so every year people ask me, what are you doing for the New Year's? And I say hiding at home with my family. So I actually took the opportunity to get a massage, go to yoga, and sort of avoid the whole New Year concept. And so it's a lot of fun. I get to spend lots of time with my family, but I have a general policy that I don't do New Year's resolutions as a result, but I do pick a word of the year. So every year I have a word of the year, and I actually went and did a painting project this week where I painted my word of the year and hung it in my office in my home. So super excited for that. Looks like many of you have voted here, and like you or like me, you also are not big on these New Year's resolutions. So let's close that one out. So 60% of you did not make a New Year's resolution. 40% of you did make a New Year's resolution. So good for you guys who chose to go down that New Year's resolution path. All right, so the next one is the generic update. So as I said, every year FASB puts out these codification improvements. It's a standing project. If you ever find an error on FASB's codification, there's actually a button to submit edits to the codification, and they just track them, and then every year they put out this codification improvement. You will notice that there are a ton of areas impacted. Now, again, these are not meant to be huge changes in guidance. They're really intended to be, oh, I have other people who have their birthday there too. I got some adjustments here, some people telling me, very exciting. Well, happy birthday to you guys as well. So we are birthday friends. I actually, my nephew was born on January 1st. I gave my sister a really hard time about that one. So I wanted to share my birthday with my nephew, but it just didn't work out that way. She went into labor on my birthday, but delivered on January 1st. So no tax deduction for that baby. Not that you get a tax deduction anymore anyway, but fun. Awesome. So none of these should have a huge impact. Some of them are just changes in examples. Some of them are updated language. One of them is a typo. So this is all the areas that got an update. So what I would recommend for you guys is to just go into the ASU, look down the list of items, see if any of them could impact you, read what the change is, and then make a decision. So that is the easiest way to do it. In terms of effective dates, to make this even easier, most don't even have transition guidance. Like they literally are just fixing the edit and they're not doing, there's no transition for it. Others do have transition guidance and they actually have a really nice chart in the ASU by number that tells you if it does have an effective date, what that effective date is going to be. So I would definitely, again, scan it if I was you, make sure that you look to see if there are any topics that would be of interest. But for the most part, that is not something that's going to rock your world. Again, we talked about how they like to keep some of the bigger projects separate, and so that's exactly what this ASU is doing. They are correcting some of the codification in this area. So this is now in particular related to leases. So again, some incorrect references, some examples, clarified some information about transition guidance, nothing here that's going to, again, really hopefully rock your world, but really what they're just trying to do here is let you know that they are making the change and they want you to know it specifically for leases, because if you're adopting leases, you want to be able to look at all of the changes at the same time. And so they gave this as a separate ASU instead of lumping it into the generic codification improvement. So this should be adopted with ASU 2016-02. If you had early adopted 2016-02, it was just going to be effective upon issuance. Now, this one is also a lease standard, but this is not just a bunch of technical corrections. These are actually improvements that were being made. And so when we look at the improvements under 2018-11, there's two areas that they really wanted to focus on. So the first one was related to transition method. When they issued ASU 2016-02 initially, they only offered one method for transitioning, which was the modified retrospective transition. However, if you're a public company, the requirement was that you would adopt the standard at the beginning of the earliest period presented, which meant that for public companies who are doing this in 2019, it would actually start January 1 of 17 for presentation purposes. And what we found was if you had a lease that expired in 2018, and obviously when you adopt the standard on January 1 of 19, it's already expired. But because you have to go back to the earliest period presented, you'd actually have to go and restate the prior periods for something that's already expired. And so people said, is there any other alternative to this? And FASB ultimately says yes. They do allow now an alternative method. You get to choose which transition method you want, but now they allow a cumulative effect adjustment in the opening balance in the period of adoption, meaning you don't have to restate prior year. You do have to do the retrospective. You would just pump the adjustment into your retained earnings without restating prior year. So that would be an alternative that you can decide as you go through this. I do want to remind you that we have a lease webinar coming up on Monday, and it is an awesome lineup of instructors. You have three really awesome people who will be going over how to implement the standard. So I highly recommend you sign up for that webinar. They are really rock stars. They are the people who were behind Terry Bekaert's whole implementation plan for leases. So I would encourage you to sign up for it. And they're going to talk about transition, and they're also going to talk about lease and non-lease components. basically here, when they initially issued the standard, the general rule is that you have to separate lease components from non-lease components. So an example would be your actual building lease from your CAM or common area maintenance. However, lessees were given a practical expedient to not separate and just lump it all into one component. Lessors were not given that practical expedient, and basically what ASU 2018-11 does is provide that practical expedient for lessors as well. So there are some catches. You have to qualify to use the practical expedient, and then it does change how the election of the component would work. So as a result, there are some disclosures if you elect that practical expedient to let people know that you elected it, what classes of assets you elected it, and what that impact was in terms of the nature of the accounting. So that would be something that you would definitely want to consider if you have lease and non-lease components. This also would be adopted with the lease standard. All right, so what are we hearing? Most people are like, I don't even know where to start adopting the standard. I don't know, what I should be doing, what policy elections I should select, what practical expedients. I feel overwhelmed. What can I do? Well, Cherry Bekaert can help. So for all companies, we can help with you to help you come up with an implementation plan. We can provide training and education on site or as a webinar specifically for your people. We see a lot of people really liking that option. We can actually help with brainstorming sessions to look at certain lease terms. We can help provide access to lease maintenance software, and one of the things they're going to do is demo some of that on Monday, so you'll be able to see some specialized software that Cherry Bekaert has worked with to be able to manage leases, and so you can check that out on Monday. And then also analyze impact of this. So what would happen to your finance statements, debt covenants, et cetera. If you are an attest client, because of our independence issues, we can only do certain items. So all of those would be acceptable for an attest client. However, if you're not an attest client, maybe you're a tax client or you're a non-attest service, maybe you're only getting a compilation, we also could help draft your accounting policies and manuals. We can help analyze contracts and help you put that information into lease maintenance software. We can help ensure that you properly identify all your leases, and we can draft financial statement disclosures. Because of our independence issues, we cannot do this for our attest clients. So we do want to make sure that we keep our independence for our audit clients. And so if you are an audit client, I would totally reach out to your auditor and make sure you're having this conversation. And also, again, make sure you're joining us Monday to chat with a really awesome group of people about the new lease standard. All right, I didn't see too many of you coming from financial services on the line today. So basically, ASU 2018-12 is related to long duration contracts. So a few years ago, they changed short duration contracts, things like medical, dental, if you had car insurance, those type of insurances. This is looking at long duration contracts. So this would be things like life insurance. And instead of trying to overhaul a new accounting model, they opted for just adjusting certain items and do some targeting improvements. And so basically, this only applies if you're an insurance entity that issues long duration contracts. It does not apply to non-insurance entities. So you want to make sure that you're within scope here. They make some changes to assumptions, moving from them being fixed or locked into being updated at least annually. In the old standard, the discount rate was pretty much unobservable. It moves it to an observable fixed income instrument yield. There were two different models for market risk benefits. Under the new standard, they're going to require everyone use fair value. For deferred acquisition costs, there were a bunch of different amortization methods, and they're going to move everyone to a constant level basis over the expected term. And then in the past, there were very limited disclosures going forward. There are going to be a lot more disclosures about inputs, judgments, et cetera. So you'll see that as a pretty big difference there. So for public business entities, this would be effective for 2021 calendar year ends, everyone else 2022. However, early adoption is permitted. All right, so some of you are saying that you did not receive an invitation to the lease webinar. We will absolutely reach back out to you for that, or you can always go to the CBH website, and all of our upcoming webinars are listed out there. So you can just go out. You don't need to receive an email invitation, but we will absolutely get that invite out to you. All right, the next two areas are related to the Disclosure Framework project. So FASB went through and updated all of their disclosure framework to create a new chapter in the conceptual framework regarding the financial statement notes. Well, questions popped up regarding how we would apply this in the real world. And so that's basically what they did. They took the Chapter 8 that they just created and went back and looked specifically at fair value measurements. And then they said, okay, based on our new conceptual framework for how we write our disclosures, we can either keep it, change it, or get rid of it. And then they said, and sometimes we might need a new one. And so they took all the concepts that were in Chapter 8 and they applied it to the current standard. And what you'll find is that they removed a whole bunch of disclosure requirements. So if you have a ton of fair value measurements, you might want to look at the standard to see all of the disclosure requirements that would go away as a result of this. Some of the removals are for non-public entities only, and then they have a couple of modifications. The only additions were related to public companies in this area. So if you're a private company, there are no new disclosures related to fair value, but if you're a public company, they do have some new ones there. So this is effective for everybody for fiscal years beginning after December 15 of 19. However, early adoption is permitted. And one of the cool things about this is you can early adopt the removal and delay the adoption of the additional. So they actually let you cherry pick how you apply the standards. So that's kind of cool. They then did the same thing. They took Chapter 8 of the new disclosure framework and they said, how can we apply this to? And this is particularly to define benefit plans for the employer. So if you're an employer and you have a defined benefit plan, you know that that's several pages of disclosures. And so they did the same thing. They went back and they removed a bunch of disclosures. They removed them sometimes for non-public, sometimes for public. They did add a couple. One of the ones that they added was a weighted average interest credit rating and an explanation of reasons for significant gains and losses. So they did add a few, but then they also have quite a few modifications as well. So this one will be effective for fiscal years ending after December 15 of 2020, which would be calendar 21 for public business entities, and everyone else calendar 22. Early adoption is permitted, and it is retrospective application. One of the more popular ones people really like to hear about is related to cloud computing. So back in 2015, they issued an ASU on how we treat the fees paid in cloud computing. And then the question came up was, well, I'm not talking about the fees, the monthly or annual fees. Was there any portion of the implementation costs that could be capitalized? And so, yes, going forward, even if you are required to expense the monthly or the annual fee, there are some implementation costs that actually will be capitalized, and you're going to use the internal use software. So basically, if you are in the product, if you're in the application development stage, those costs are allowed to be capitalized, whereas the preliminary project or post-implementation stages are going to be expensed. So an example of that would be, for example, training costs are going to be expensed and not capitalized. But for a lot of people, this will take a lot of the cost off of the income statement, put it on the balance sheet, and then spread it over the term of the hosting arrangement. And so a lot of people really like this standard. All right, checking the questions that are coming in. So this one is effective for calendar 2020 for public business entities, 2021 for everyone else. And if you are audited by Chair Bekaert and you're in the process of doing an implementation to a cloud, I would definitely recommend you talk to your partner about this. All right, let's take a look at our next polling question here. Again, wanted to get some feedback from you. This is our last polling question of the day. And this one is, have you already broken your New Year's resolution? So if you didn't make one, then obviously you can't break it. But if you were one of that 40% who created it and we're in day 10, have you already broken it? And let's kind of get a feel for what you guys think here in terms of this. And looks like many of you are going strong on your New Year's resolution, which is awesome. I don't do them because I don't think I could keep up with it, but super excited. I know you don't want to go to the gym in January because everyone goes to the gym in January. My girlfriend says, I skipped the gym in January, I start again in February, so that would be fun. So there's a question here about the ASU number for cloud computing. It is ASU 2018-15, and you would be able to apply that to some of the software as a service. So absolutely, you can definitely check out those hosting fees and look at those implementation for cloud computing. All right, excellent. Well, we're going to close that one out. Bravo to those of you who are holding strong there, 30% of you, which is 30% of the 40%. So that's really awesome. Did great in that area. All right, we're going to close up with just a handful more of ASUs. The next one is related to the LIBOR drama. So you probably are familiar with the fact that we have learned that LIBOR is not as honest as we used to think it was. We learned that there's actually been significant manipulation of LIBOR, and as a result, the federal government actually required that we create a committee, just like we always do, and they created a committee, and their job was to find a different rate. And so the Fed actually said we need to find a new rate to replace LIBOR. And they selected the SOFR, Secured Overnight Financing Rate, and said we're going to use the SOFR to replace LIBOR. Catches, in U.S. GAAP, you have to be an eligible benchmark rate. Well, SOFR was not an eligible benchmark rate, and so ASU 2018-16 takes SOFR and makes it an eligible benchmark rate so that we can replace LIBOR over time. This is effective with the changes to hedge accounting, which are not yet effective, which is in 2017-12. So if you haven't adopted 2017-12 yet, you would just adopt it with that standard. If you early adopted hedge accounting, which many people did because it's such an awesome standard for early adoption, then they gave you basically what you would have done had you adopted ASU 2017-12 on time. So they did give you a little bit of an adjustment here. But 2017-12 just has so many really great options for private companies in there. We saw a lot of early adoption. All right, the next one is 2018-17. This is my personal favorite. So if you waited all the way to now, this is my favorite. Now, many of you are nonprofits, so this doesn't impact you, but for your private companies out there, this one is going to make you very happy. The Private Company Council did some pretty amazing things here. So we all know that we have this thing called a variable interest entity. Very few people understand the accounting. It is incredibly complex. It's also very expensive. And back in 2014, the Private Company Council said, hey, if you are a private company and it's a lease company that's under common control, we're not going to make you do VIE guidance. Well, people said, thank you very much, that's awesome, but is there any way that we could get a little bit more of an exemption? And this is it. So if you have a legal entity and the reporting entity and the legal entity are under common control, and the reporting and legal entity are not under common control of a public business entity, again, this only applies to private companies, and the legal entity under common control is not a public business entity, again, focusing on this as a private company exception, then basically you have an opt-out of VIE guidance. So common control relationships are no longer subject to VIE guidance if you are a private company. You would not evaluate any VIEs under this. You're just exempt altogether. Now, this is an option. This is something that you would do as an accounting policy election. You don't have to. However, if you elect the policy, you must apply it to all legal entities where you meet this criteria. You cannot cherry pick. So I'm a huge fan of this ASU, and so if this is something that applies to you, I would definitely take a look. There are quite a few disclosures, obviously, because you're no longer going to be evaluating those entities. They do want you to at least disclose your risks related to those entities. It's effective for 2020 for companies that are not private companies. For private companies, it is for 2021. However, early adoption is permitted, and I highly recommend that if you have these VIEs and they do not benefit you and they don't feel like they represent your true accounting of your entity, this is a great early adopter. Collaborative arrangements has its own topic, topic 808, and unfortunately, 808 really needs some help. It's probably one of the weakest areas in the codification. It does not have comprehensive recognition or measurement guidance. So we basically use analogy to handle topic 808. And a collaborative arrangement is an arrangement where two or more companies, typically parties, actively participate in a joint operating activity, and as a result are exposed to the risks and reward that depend on that activity's commercial success. So maybe you want to work with another entity on creating a new project, or we see this in pharmaceuticals pretty frequently. Not-for-profits also have quite a few collaborative arrangements. So they work with another entity on a project and then the accounting for it. Well, the question that came up was, if I have this collaborative arrangement, is it possible that I'm a customer under topic 606? And it does clarify that you could be a customer under topic 606, and if you are, then you should follow revenue recognition, so the collaborative arrangement should be accounted for as revenue. Unfortunately, it does not provide any new non-revenue transaction accounting. So if you are revenue, it says follow topic 606. However, if you don't qualify for non-revenue, so you're not in topic 606, it does not give you any accounting. So it still stays with very few accounting guidance in this section, but it does give that clarification. So for public business entities, it would be 2020, everyone else 2021, however you can early adopt. Here is another one that is related to codification improvements. This is specifically for the CECL model, which is the current expected credit loss model. Huge impact on banking. It can impact others, but banking is really the big one here. And the CECL model replaces the incurred loss model. It removes that probable threshold for recognizing losses. Well, again, just like before, these are codification improvements, and instead of lumping them into the traditional one, they wanted to call attention to the fact that this was before the CECL model. And so there's two things that they really impact here, which is the effective date. They gave three effective dates, but if the effective date was the same for public business entities that were not SEC filers as it was for non-public entities. And so it ended up that the only one who had to early adopt was SEC filers, and then public business entities that were not SEC filers were going to adopt with non-public entities. And the non-public entities said, can't you give us more time? And the answer was yes. So they basically pushed back the effective date for non-public business entities an additional year as a result. In addition, scope, there was questions about the scope. The scope explicitly said that if you're a lessor, your sales type and your direct financing leases were in scope of the standard, but it was silent regarding operating leases. And so it clarifies that operating leases are not in the scope of the CECL model. They are not going to be subject to the current expected credit loss. So this one is effective, again, with the ASU 2016-13, so which would be for SEC filers 2020, public business entities that are not SEC filers 2021, and everyone else, including nonprofits and EBPs, 2022. And there were restrictions on the early adoption here, which is why we don't have to worry about early adoption. Our last and final ASU of the day is related to lessor accounting. And in this scenario, we're going to handle three different issues related to lessors. The first one was sales tax. The actual guidance in topic 842 basically required us to say jurisdiction by jurisdiction. Am I collecting on behalf of a third party, say a state, and collecting it from the lessee, and I'm just being an agent. I'm taking it from the lessee, and I'm giving it to the state, and I'm just sort of an in-between. Or am I primarily obligated as a lessor, because I'm the owner of this asset, for sales tax, and then I'm just getting reimbursed by the lessee? Well, in that scenario, you actually get different accounting. If you're an agent, that money is going to be excluded from lease revenue. But if you are primarily obligated, then it would be included. And people said, are you really asking us to analyze the legal jurisdictions? And FASB said, well, maybe not. So it is going to allow lessors as an accounting policy election to just treat those as lessee costs and exclude them from consideration. Again, that is an option if you really want to go through and evaluate every jurisdiction. More power to you. You absolutely can. Very similar question related to lessor costs. The question was, are these lessor costs being paid on behalf of the lessor, or are they paid as a reimbursement to the lessor? So if the lessee is paying those costs and they're paying them directly to the third party, right, then that is going to be very expensive for the lessor to know, right? So if they're paying a bill that really is for the lessor, but the lessee is paying it, and it's going directly to the third party, the lessor has no idea. So they'd have to estimate what the lessee is paying directly to those third parties. And people said, does that make any sense? And they said, no, going forward, you exclude any variable payments that are costs paid by the lessee directly to third parties. You would exclude them from consideration going forward. And then it also looked at variable payments for non-lease and lease components, and basically said any variable payments have to be allocated between lease and non-lease components. And then if it is a lease component, you're going to follow Topic 842. If it's a non-lease component, you would follow something like Topic 606 for revenue recognition. And so again, you're going to follow this with ASU 2016-02. If you did early adopt, you have three choices. You could either do it on the original effective date, or the first period ending after the issuance date, or the first reporting period beginning after the issuance of the standards. You had lots of choices on effective date. Whew, we made it. It is 12:01 Eastern time, so I apologize I went 1 minute over. But thank you guys so much for joining me. I think I've answered all the questions that came into the chat pod, so thank you guys so much for being active participants today. I appreciate you joining us on this annual update. FASB definitely kept us very, very busy. So thank you so much for joining me. Again, I encourage you to join us on Monday. We will get those invitations out, but you can always go to the cbh.com website and sign up there. Thank you guys so much. Happy 2019, and I hope to see you on future webinars. Have a great day, guys. Bye-bye.